episode of our FinLab podcast titled Pintar Uang Campaign. Today we're diving into the fascinating world of venture capitalists and how it fuels innovation across the world.
Unlike traditional financing, venture capital plays an important role in startup business to improve their performance, but how exactly does it work?
To help us explore this topic, we have two very special guests today, Nishan and Annabelle.
Thank you so much for joining us.
Thank you for having us. It's a pleasure to be here.
And we're excited to share some insights and talk about venture capital and the startup ecosystem with everyone.
Alright, so let's get started. So on to the first question. To start off, could you explain what venture capitalist is and how it differs from other types of financing?
Certainly. So venture capital, or VC, is a type of investment where investors provide funding to startups and high growth companies in exchange for equity ownership.
Unlike traditional bank loans, startups are not required to repay the money immediately or provide collateral.
So instead, venture capitalists take on higher risk with the expectation that the company will grow significantly in the future.
And what makes venture capital unique is that investors not only provide capital, they also provide mentorship, industry expertise, and access to networks that can help startups scale more effectively.
Thanks for the answer, guys. But how does a typical investment works in venture capital, from sourcing startups to exiting investments?
The process usually begins with sourcing opportunities. We discover startups through referrals, networks, startup communities, and also industry events. Once we identify a promising company, we conduct a due diligence. This involves evaluating the founders, market size, product, competitive landscape, and also their business models.
So if everything aligns with our investment thesis, we make the investment and continue supporting the company throughout its growth journey. Eventually, successful investments may result in exits through acquisitions, mergers, or initial public offering, which allow investors to realize returns.
I see. That's very insightful. Thank you. Now to the next question. How does the process of building a company through a joint venture usually work?
A joint venture usually involves two or more parties collaborating to create the business together while also sharing the resources, expertise, and also risk.
So the key to be a successful joint venture is alignment in goals and values. Each party should bring a complementary strengths to the table, whether that is technology, market access, operational capabilities, or capital.
Strong communication and trust are also essential to ensure the partnership creates a long-term value.
I see. So, what are the key stages of venture capital investment?
So generally, startups go through several stages. So the first is the pre-seed stage, where founders validate their ideas. Secondly, it's the seed stage, where startups begin developing products and attracting early customers.
Then later comes Series A, where the focus shifts toward the scaling the businesses. Later rounds, such as Series B and beyond, are aimed at expansion, market leadership, and eventually preparing for exits. Each stage comes with different levels of risk and also expectations.
I see. So it's definitely more complex than we thought. And on to the next question. What are the biggest misconceptions founders usually have about this capital?
Usually, the biggest misconceptions that founders usually have is that securing funding equals to success. In reality, funding is simply just a tool. Success ultimately depends on the execution and also creating value for customers.
So another misconception is that investors only care about financial numbers. So in practice, we place significant emphasis on the quality of the founding team, their resilience, and their ability to adapt to these challenges.
Oh, that's interesting. But why do some startups with perfect pitch decks still fail to secure funding?
So because a great presentation alone isn't enough, investors are evaluating whether there's a genuine problem being solved, whether customers truly need the solution, and whether the team is capable of executing the vision.
Timing, market conditions, and competitions also play important roles. Sometimes it's not just about the deck itself. It may simply not be the right opportunity at the right time.
So it's definitely a more complex situation than rather than just a one big thing. So following to that, what are the red flags that immediately concern you during a pitch?
Actually, several things stand out. First, when founders don't understand their own metrics or financials. Second, unrealistic assumption and also exaggerated projections.
So the third is that founders who are unwilling to accept feedback or entrepreneurship, they require continuous learning and they are able to acknowledge their weaknesses.
But do you guys think Indonesian culture is a copycat startup culture, or are we beginning to see more original innovation?
In the early stage of ecosystem development, adapting successful business models from other markets is really completely normal. However, I believe we're increasingly seeing more original innovation, particularly in sectors such as AI, fintech, healthcare, agritech, and also climate technology.
So many founders are now addressing uniquely Indonesian and Southeast Asian problems, which create opportunities for global relevant solutions.
I see. We're very glad to hear that it's increasingly more common to see original innovation from Indonesia and Southeast Asia at the same time. So, why do many startups fail even after successfully raising millions in funding in the first place?
So capital alone cannot compensate for weak fundamentals. Many startups prioritize growth without achieving product market fit or establishing sustainable economics.
Rapid expansion without proper discipline can also create operational inefficiencies and burn through cash quickly. Ultimately, strong execution matters more than the amount of money that were raised.
Speaking of weak fundamentals, what are the difficult conversations the investor usually have with struggling founders behind the scenes?
So these conversations often involve difficult decisions regarding cost reductions, restructuring, strategic pivots, or changes in leadership. So our role as investors is not only to celebrate successes, but also to support founders during challenging periods.
Transparency and trust are also crucial because building a startup is both financially and emotionally demanding.
Alright, following to that, as we know in this generation, AI is getting more and more prevalent. So, do you think that AI will reduce the importance of human intuition and venture capital?
So AI is an incredibly powerful tool that helps us analyze markets and identify patterns more efficiently. So, however, venture capital remains fundamentally a people business.
Understanding founders, assessing leadership qualities, and building trust require humans' judgments and intuition. Therefore, I believe AI will complement us rather than replacing us humans on decision making.
That is such a profound way to look at it. And what was the most memorable founder pitch you've ever heard, and why?
So, interestingly, the most memorable pitches are not always the most polished.
The founders that stand out are those who possess genuine passion, deep understanding of the problem, and also extraordinary perseverance.
So, authenticity and conviction often leave a stronger impression than perfect presentation slides than perfect.
Right, so now on to ESG and the impact. How is ESG and impact integrated into investment decisions?
So, sustainability has become an incredibly important consideration. We evaluate environmental, social, and governance factors because responsible businesses are generally better positioned for long-term success.
By integrating ESG principles, we aim to create value not only financially but also socially and environmentally.
So, how do you ensure that the portfolio companies grow responsibly while still achieving strong financial performance?
Responsible growth and financial performance should go hand in hand. We encourage companies to establish strong governance practices, foster inclusive cultures, and build sustainable business models.
So, in the long run, businesses that prioritize responsibility tend to be more resilient and competitive.
So now let's talk about the future outlook. For the next wave of startups, what do you think will define the next wave of successful startups, both in Indonesia or in Southeast Asia?
I believe technologies such as artificial intelligence, climate technology, healthcare, and financial inclusion will drive the next wave of innovation.
Founders who deeply understand local problems and leverage technology to solve them will create the greatest impact.
So, how are venture capitalists adapting to current global economic challenges and funding trends?
Today's market environment emphasizes sustainable growth and profitability more than ever before.
So investors are becoming more and increasingly disciplined, focusing on companies with stronger fundamentals, and it gives a clear path to long-term value creation. So, despite economic cycles, innovation remains a powerful driver of growth and opportunity.
Okay, so for the last question, how is Ventures adapting to current global economic challenges and funding trends?
Today's market environment emphasizes sustainable growth and profitability more than ever before.
So, investors are becoming increasingly disciplined, focusing on companies with stronger fundamentals and gives a clear path to long-term value creation. So, despite economic cycles, innovation remains a powerful driver of growth and opportunity.
Thank you very much. So before we wrap up, what advice would you give to first-time founders seeking funding from venture capital firms?
So, my advice would be to be focused on solving meaningful problems rather than simply chasing investment. Build products that customers generally love, understand the market deeply, and surround yourself with talented people.
And most importantly, remain resilient. Entrepreneurship is a journey filled with uncertainty, and persistence often makes the difference between success and failure.
Okay, unfortunately, we've reached the end of today's podcast, and thank you so much for our guest speaker for sharing such valuable insight on venture capital and the startup ecosystem.
Thank you for having us.
It was truly a pleasure, and I hope our discussion inspires more students and aspiring entrepreneurs to pursue innovation and contribute also to Southeast Asia's and also Indonesia growing digital economy.
And also, thank you to our listeners for tuning in to our Pinter Uang campaign. We hope today's episode has helped you better understand how venture capital shapes innovation and creates opportunities across Southeast Asia. Until next time, stay curious, keep learning, and thank you for listening.